Let's talk about the tax strategy gap that most business owners never see. If you have built a successful business in the United States and you are still paying taxes like you are simply a W-2 employee, this video may change the way you think about building, protecting, and transferring wealth. I'm not here to give you a teaser, hide the ball, or dress up surface level information and strategy. I want to talk about the gap. My name is Randolph Love III. I am the founder and CEO of Shieldwood Strongholds. I have been in the insurance and financial services industry for almost 2 decades, and today I work alongside of the top 0.1% financial professionals in the United States. I'm one of them. We have implemented advanced strategies for 7, 8, and 9-figure business owners. And the first thing I learned was the gap, not a loophole, not a conspiracy, not some secret backroom trick reserved for only billionaires. The gap between what most business owners are told and what the tax code actually allows. The gap between tax compliance and tax strategy. The gap between what your CPA is trained and licensed to do and what you may require a different professional license, a different design process, a different planning conversation altogether. Most successful business owners are not overpaying taxes because they have a bad CPA. No, in many cases, they are overpaying because the strategies that could help them most sit in the intersection of two worlds, tax planning and tax-based financial design. And if your advisor only lives on one side of that intersection, there is a good chance no one has ever fully explained the entire picture to you. That is what this video is about. I want to pull back the curtain on how successful business owners can use legitimate IRS recognized strategies to reduce unnecessary taxes, build tax advantage wealth, protect their families, and create more efficient retirement and legacy planning. But before we go any further, let me be very clear. This is educational content only. This is not personalized legal, tax, insurance, or financial advice. Every business owner's situation is different. Before implementing anything discussed in this video, you need to work with a properly licensed and qualified professionals who can evaluate your specific facts, your business structure, your income, your goals, your tax situation, and your long-term planning needs. So once again, this is information, not advice. Now that we have that clear, let's get into it. In this video, I want to walk you through 6 major ideas. First, why there is a gap between what your CPA knows and what you may actually need. Second, the tax code sections that allow business owners to create deductions while building tax advantage wealth. Third, the critical difference between tax deferred and tax free. Fourth, how major corporations and executives have used similar planning concepts for decades. Fifth, who these strategies may be designed for, and just as importantly, who they may not be designed for. And 6, what you should actually do with this information. Because remember, knowledge is only potential power. Applied knowledge is power. But I want to give you the most important point right now. The reason many business owners overpaying taxes is not always because they have a bad CPA. That's not the reason. It's because some of the most powerful strategies available to business owners exist at the intersection of 2 different professional worlds. Your CPA is trained in tax compliance. They help you report income, deduct expenses, file returns, and stay compliant with the IRS. But certain strategies involve tax rules and insurance-based planning. That means you may need a professional who understands business tax strategy and also understands properly structured life insurance, executive benefits design, retirement planning, and long-term wealth transfer. That is the gap. And once you see the gap, you can start asking better questions. So let's start with chapter 1. What is the gap? Let me ask you a question. If there were legal strategies inside the Internal Revenue Code that could potentially help business owners reduce taxes, build wealth, and improve retirement planning, why has no one explained this to them or this to you? When I first started learning about these strategies, I asked the same questions. I wondered, what is the catch? Are these strategies too risky? Are they sitting in some gray area? Are they only for billionaires, Fortune 500 CEOs, and people with private jets? But the more I studied, the more I worked alongside high-level professionals who implemented advanced planning for successful business owners, the more I realized something important. Many of these strategies are not new. They are not exotic. They are not hidden in the shadows. They are built on sections of the Internal Revenue Code that have existed for decades. The problem is not strategies do not exist. The problem is access to education. And my company, the way we work is elevation through education. Most business owners do not know what to ask for because they do not know what is possible. And many advisors do not explain what sits outside their own license, training, or area of expertise. Think about it like medicine. A general practitioner may be excellent. They can diagnose common issues, monitor your health, prescribe medication, and help you stay on track. But if you need heart surgery, your general practitioner is not going to perform the surgery. Nah, that PCP, that primary care physician, they're going to send you to a specialist, not because they're a bad doctor, not because they don't care about you, but because heart surgery requires a different specialist, different tools, different training, and a different license. The same thing happens in financial services. Your CPA may be excellent at tax compliance. Your financial advisor may be excellent at investment management. Your insurance agent may understand basic life insurance, but some of the most advanced strategies for business owners require coordination across multiple disciplines. Business tax planning, executive compensation, qualified plans, life insurance design, retirement income planning. That is where many business owners get stuck. Your CPA may understand taxes, but may not be licensed or positioned to design insurance-based strategies. Your insurance agent may understand insurance, but may not understand advanced tax strategies. Your financial advisor may understand investments, but may not understand business owner compensation planning. So the business owner ends up in no man's land, and the strategies that may help them the most remain invisible. That is the gap. So let's move on to chapter 2, the tax code building blocks. Now that you understand the gap, let's talk about what sits inside the gap. I want to break down some of the tax code sections that make these strategies possible. I'm going to keep this plain English as possible because nobody wakes up excited to read the Internal Revenue Code with their morning coffee, right? But think of this chapter as the toolbox. These are the building blocks. Later, a qualified professional can help determine whether any of these tools make sense for your specific situation. So let's start with Internal Revenue Code Section 162. Section 162 is part of the tax code that allows businesses to deduct ordinary and necessary business expenses. That can include reasonable compensation paid to employees, executives, and officers. Now, here's where it gets interesting for business owners. If you own an S corporation, a C corporation, or certain LLCs taxed as corporations, you may also be an employee or officer of your own company. You may be the founder, you may be the CEO, you may be the president, you may be the person responsible for driving revenue, taking the risk, carrying the stress, and making the decisions. Under the right structure, your business may be able to compensate you in ways that go beyond ordinary income. One example is an executive bonus arrangement. Here's the basic idea. Your business pays a bonus to you as an owner, executive, or key person. Instead of simply taking the money and the cash and spending it, the bonus may be used to fund a properly structured permanent life insurance policy that you personally own. The business may deduct the bonus as compensation, assuming the arrangement is properly structured, reasonable, documented, and compliant. The policy may build cash value over time. If designed correctly, the cash value may grow tax deferred, may be accessed through policy loans or withdrawals under certain conditions, and may also provide an income tax-free death benefit to your beneficiaries. Now, I want to slow down here. Simply buying life insurance does not automatically create a tax strategy. That is where many people get hurt. The policy design matters. The funding level matters. The ownership matters. The compensation arrangement matters. The documentation matters. The long-term exit strategy matters, and the policy must be structured properly to avoid becoming a modified endowment contract or creating other unintentional consequences. My mentor, Doug Andrews, says you don't want to make it up. And if you have a life insurance policy that's tax favored, making it up is not a good idea. That is why it is not a do-it-yourself planning. This is where you need qualified professionals who understand both the tax side and the insurance design side. Now let's talk about another category, defined benefit planning. Most business owners are familiar with 401k plans. A 401k can be useful, but for high-income business owners, the annual contribution limits may feel small compared to the amount of taxes they are paying. That is where defined benefit planning can become interesting. Unlike a 401k, which focuses on how much you can put in each year, a defined benefits plan is built around a future retirement. The question becomes, how much needs to be contributed today to fund a specific future retirement income? That calculation is actuarial. It depends on age, income, business cash flow, retirement goals, plan design, and other factors. For older business owners with stable and significant income, these plans may allow much higher deduction contributions than a typical 401k arrangement. There's also Section 412(e)(3, formerly associated with what many people call 412I plans, which involves fully insured defined benefits plans. These plans can use insurance contracts as part of the funding mechanisms. Again, this is advanced planning. It may involve Section 404 for deduction rules. It may involve Section 415 for contribution and benefit limits. It may involve ERISA considerations. It may involve Department of Labor rules. It may involve plan documents, annual filings, actuarial work, and long-term administration. So I do not want anyone hearing this thinking, I watched the video, so now I can set this up myself. Absolutely not. The goal of this video is education. I want you to understand that these strategies exist, why they exist, and why many business owners have never heard about them. Other relevant sections may include Section 61, which deals with gross income, Section 79, which deals with group term life insurance, Section 101A, which deals with income tax treatment of life insurance death benefits, Section 401A, which deals with qualified plans, Section 409A, which deals with non-qualified deferred compensation, Section 419 and 419A, which deals with welfare benefit plans, Section 264, which governs certain rules connected with life insurance contracts, and Section 7702, which defines what qualifies as life insurance for tax purposes. These are not magic words. They are pieces of a much larger planning framework. But the point is this: these strategies are not invented out of thin air. They come from the tax code. The challenge is knowing how to connect the dots. Chapter 3, tax deferred versus tax free. There is a difference. Now let's talk about one of the most important distinctions of business owners can understand. Tax deferred is not the same as tax free. This is where many people get confused. You can contribute money to a traditional 401k or traditional IRA. You may get a tax deduction today, and that does feel good. You see a lower taxable income number, and you may feel like you saved money. But in many cases, you did not eliminate the tax. You postponed it. The money may grow for 20, 30, or even 40 years. And when you withdraw it in retirement, those withdrawals are generally taxed as ordinary income. That means the IRS may still have a seat at the table. You may not necessarily remove them from the equation. You may have simply invited them to collect later, potentially on a much larger account balance. Now, tax deferred vehicles are not bad. For many people, they make sense. If you are in a high tax bracket today and expect to be in a much lower tax bracket later, tax deferred may be useful. But here's the issue. I have seen with many successful business owners, a lot of them do not retire in a lower tax bracket. They have built businesses. They have real estate. They have investments. They have rental income. They may sell the business. They may have required minimum distributions. They may have Social Security taxation issues. They may still be highly successful in retirement. So if you are a successful business owner, you have to ask a serious question. Am I really going to be in a lower tax bracket later? Or am I simply postponing taxes into the future where taxes may be higher, my account balance may be larger, and my planning flexibility may be lower? That is why tax-free planning matters. Properly structured life insurance is one of the few tools in the tax code that can potentially offer a combination of tax deferred cash value growth, access through policy loans or withdrawals under the right conditions, and an income tax-free death benefit under Section 101A. Again, this must be structured correctly. Policy loans are generally not taxable when handled properly, but if a policy lapses, is surrendered, is overfunded incorrectly, or becomes a modified endowment contract, the tax outcome can change. So design matters, funding matters, monitoring matters, but conceptually, here's the difference. With tax-deferred planning, you may be delaying taxes. With tax-free planning, when structured properly, you may be repositioning dollars into a vehicle where the growth and access can be treated very differently. That distinction can be worth hundreds of thousands of dollars over a lifetime, maybe even more. The question is not, should I use tax deferred or tax free? The better question is, what balance of taxable, tax deferred, and tax free assets should I have based on my income, business, age, goals, retirement timeline, and legacy objectives? That is the conversation successful business owners should be having. So now, chapter 4, the corporate playbook. Now let's talk about something most business owners do not realize. Large corporations have used executive compensation strategies for decades. When Fortune 500 companies want to attract, reward, and retain top executives, they do not rely only on salary. Why? Because salary is one of the least efficient ways to compensate a high earner. Once you add federal taxes, payroll taxes, state taxes in certain states, and other factors, a large portion of every additional dollar can disappear. So corporations use more sophisticated compensation planning, executive bonus plans, deferred compensation arrangement, supplemental executive retirement plans, split dollar life insurance arrangements, key person insurance, golden handcuffs, retention bonuses, non-qualified plans. These strategies are not fringe concepts. They are part of the executive compensation world. Here's the part that should matter to you. If you own a business, you may also be an executive of your own company. You may not think of yourself that way because you are busy running payroll, solving problems, dealing with customers, managing staff, handling vendors, and putting out fires. But if you are the founder, CEO, president, or owner operator, you are not just a worker inside the business. You are an executive. That means some of the same categories of strategies used in corporate America may be available to you at a scale appropriate for your business. The Fortune 500 may have millions flowing through these structures. You may have tens of thousands, hundreds of thousands, or more, depending on the business. The mechanics may differ, the design may differ, the scale may differ, but the concept is the same. The goal is to compensate key people efficiently, protect the business, retain value, reduce unnecessary tax drag, and create long-term wealth. The issue is that Fortune 500 executives usually have a team. They have attorneys, they have tax advisors, they have benefits consultants, they have insurance specialists, they have compensation experts. The average business owner may only have a CPA, a payroll company, a bookkeeper, and maybe even an insurance agent who sold you a policy years ago. That is why the gap stays hidden. The bigger companies have teams that know how to coordinate. The business owner has to discover the playbook on their own. That is what I want to change. So chapter 5, who are these strategies for? Now, let me be completely honest. These strategies are not for everyone. And anyone who says every business owner should use the same strategy is someone you should be very careful with. The right strategy depends on the right facts. So who are these strategies probably not for? They are probably not for W-2 employees with no business ownership. Many of these structures require business entity, compensation planning, and employer-sponsored design. They may not be for early-stage business owners who are still fighting for consistent cash flow. If your business is still young, unstable, or reinvesting every available dollar back into the survival and growth, then locking into a long-term premium or contribution commitments may not be wise for you at this time. They may not be right for people who need maximum liquidity. If you need every dollar in the next few, if you need every dollar in the next few years, long-term planning vehicles may create pressure or unintended consequences. They may not be right for business owners with highly inconsistent income. Many of these strategies require ongoing funding, annual reviews, and long-term commitment. Now, who might benefit from exploring them? Established business owners with consistent profitability, business owners paying substantial taxes, business owners who have already built strong cash flow and want to reposition dollars more efficiently, business owners who want to accelerate retirement planning, business owners who are concerned about future tax rates, business owners who want tax advantage income later for life, business owners who want to protect their family with death benefit protection, business owners who want to create legacy wealth, business owners who are tired of working hard, earning more, and watching too much of the harvest leak through unnecessary tax drags. These strategies require patience. They require discipline. They require proper design. They require documentation. They require coordination. They are not magic bullets, but for the right business owner, they are very powerful. They might be. So chapter 6, what to do next. So now that you understand the gap, what should you do? First, do not, I repeat, do not fire your CPA. Your CPA is still important. You still need tax compliance. You need clean books. You need accurate returns. You need someone who understands your business from a filing and reporting standpoint. The goal is not to replace your CPA. The goal is to bring the right specialist to the table. Second, internalize the gap. There may be strategies your CPA has not brought up, not because your CPA is bad, but because those strategies may sit outside their license, their business model, or their normal planning process. Third, evaluate your situation honestly. Are you an established business owner? Are you consistently profitable? Are you paying significant taxes? Do you have the ability to commit capital over time? Do you want to build tax advantage retirement income? Do you care about tax? Do you care about business succession, legacy, or family protection? If the answer is yes, then it may be time to explore advanced planning. Fourth, find professionals who understand the intersection. You want people who can coordinate with your CPA, attorney, insurance professional, financial strategist, and other advisors. The best strategies are not built in isolation. They are built through collaboration. There's innovation in the team. That's something that's very true. Fifth, run the numbers. Do not accept vague promises. Do not accept generic examples. Do not accept hype. You should understand the projected contributions, deductions, costs, risks, liquidity limitations, long-term values, policy metrics, and exit strategies. Real planning should be specific. It should be documented. It should be customized, and it should be explained in a language you actually understand. Here's the bottom line. Most business owners spend years building wealth, only to discover too late that they were never shown the full planning menu. They were shown compliance. They were shown basic retirement accounts. They were shown ordinary deductions, but they were not shown the gap. Now you know it exists. And once you know it exists, you can ask better questions. As Shilwa Stronghold, this is the world we live in. We help business owners think differently about risk, opportunity, taxes, retirement protection, succession, and legacy. Because building wealth is one thing, keeping it, protecting it, and transferring it efficiently is another. If this video helped you see something you had not seen before, I want you to take the next step. Start by asking better questions. Talk to qualified professionals. Look at your business structure. Review how much you are paying in taxes. Evaluate how much your wealth is taxable, tax deferred, and tax free. And ask yourself one honest question. Am I using the same basic playbook as everybody else? Or am I building with the tools successful business owners actually need? I am Randolph Love III, Chartered Financial Consultant, Chartered Life Underwriter, Chartered Property Casualty Underwriter, fellow Life Management Institute, and Retirement Income Certified Professional. I'm the founder and CEO of Chillwell Strongholds. Thank you for watching. And remember, the gap is only dangerous when you do not know